We've got some fresh new young talent doing some things that I know you haven't heard before.
1, 2, 3, listen.
Welcome to Finances, your home for all things financial, investment, money and lifestyle. Hosted and curated by the very talented team of certified financial planners, Burke, Britton Financial Partners.
Thank you for coming along. I'm Delta Smith, and I'll be joined tonight by my co-presenter and colleague, Ben Kemp. We're from the Burke Britton Financial Partners team, and we're really pleased to be collaborating with the Loan Market Geelong team. Are also joining us. So we've got Sarah here on tonight's presentation, and the topic is wealth creation. So something that we are all interested in. I'm just going to share my screen and bring up tonight's presentation. So bear with me. So as I said, we'll be chatting about wealth creation tonight and just having a bit of a run through of some strategies that we might look to utilise to generate wealth creation as quickly as possible. So a little bit of housekeeping. You're all on mute at present, and my colleagues will let anyone else who might be in the waiting room in. So if you've got some questions that pop up during the course of our conversation this evening, feel free to pop those in the chat function, or if you'd like to, you can keep them until the end of the session where we do have some time set aside for a Q&A, or question and answer session. So for most of you here, you're probably aware of the role that the fantastic loan market team play in ensuring for you that you can finance, a home, investment property, commercial premises, and so on, and the comfort that their expertise as mortgage brokers provides you with. Some of you present this evening may not be as familiar with financial planners and what we do, so we thought it might be worthwhile just providing a quick introduction. So from our point of view, we meet with a client, we consider all your current financial circumstances, we chat about what your financial objectives might be and also your lifestyle objectives, and then we work together to tailor a plan with advice and strategies to help you achieve those financial and lifestyle goals. During the course of our conversations, we talk about things like your cash flow, any opportunities that you have within your current situation that we might make use of, and also threats so that we can be in a position to mitigate those as much as is possible. From a process point of view, we have an initial discussion just to ensure that what you need is something that we can deliver. Then we have an initial sit-down meeting, whether that be on Zoom, like this evening, or in person, whatever might suit you best. During the course of that meeting, we do try and listen a lot, and that's for us to get to know you and start fleshing out what some of your goals and aspirations might be. And then we work together to provide strategies and advice to actually allow you to achieve each of those. I thought maybe a good way to address some of the things that we don't do as financial planners is just to quickly talk about some of the common myths that persist. So the first one that pops up a fair bit is just around needing to have lots of money to see a financial planner. Now, that's not true. We can help most people, most families, and we can add value to their circumstances through the expertise that we can provide in our field. So that's not the case. We can help most people. The second one is one that pops up quite a bit, and that's around whether we lodge tax returns. No, that's actually a function of your accountant for your tax return to be lodged, but we can certainly assist you with strategies around, say, minimising your taxable income so that you're paying less tax. So we can work in conjunction with your accountant. The third one, which is really relevant for tonight's content, is just that perhaps we're biased towards things like shares and managed funds as financial planners, as distinct to, say, property. That's not the case. We really love property, and any investment decision that gets made just needs to have a clear purpose or function with that investment. So just assessing that that's the right fit. I've run through that quite quickly, so if any questions have arisen during the course of that, you can either submit them in the chat now, or we can hopefully have time to run through each of those in the Q&A session later. So, wealth creation strategies. I don't know if anyone's looked at that and got really excited by that content. Probably not. For us, I suppose, we do have a sense of excitement when we look at these strategies, and that's simply for us. These strategies enable us to help our clients succeed. We share in their wins when they're in a position where their goals or aspirations have been met. And ultimately, all of these things allow our clients to have lifestyle options. So, you know, not the most compelling of titles, but really relevant to most people's situations. So there's a couple of different topics that we are going to touch base on, and myself and Ben will run through those. So I'll touch on the first one and then I'll hand over to Ben. So when we look at borrowing to invest, it's fair to say that most of us here who own our own home at some point in time had borrowings to fund the property purchase. This can extend to other sorts of wealth generation. So whether that be an investment property, looking at borrowing for shares or other purposes. And the borrowing component simply allows us to have additional capital or money available to invest. And the purpose there might be that we want to be in a position where we can produce some passive income being that we don't actually physically have to go to work and generate income. We've got investment assets that are creating that income for us. And over time, ultimately, what we'd like to see is capital growth. So that's a very quick introduction to borrowing for invest. And now we're going to run through some of the other concepts. We won't get too bogged down in details. We'll just give you a high-level overview. So, Ben, I'll hand over to you to talk about the next couple of points.
Thanks, Delta, and thanks everyone for jumping on. Debt recycling, we probably could talk about it for a couple of hours, but we'll try and condense that down to a couple of minutes. So in really simple terms, debt recycling is basically turning your bad debt into good debt. And what we mean by that might be a term that people have used before, but it's basically turning your bad debt, which is, you know, your non-deductible debt, into deductible debt, and using that strategy to speed up basically the repayment of the loan against your home that you live in really simple terms. So for a lot of people, they've accumulated equity in their home in recent years. The market's been quite good, or they've paid that loan down. It's basically looking at using that equity to not just sit there and look nice on paper or be comfortable for the bank, but to actually utilize that to create more wealth, more income streams, and ultimately using more debt to speed up the repayment of the initial debt you took on. So sometimes that can feel a little bit counterproductive, but you know, in line with the third point of minimizing tax, if you can have your debt in the right places, the effective interest rate can be far lower, which helps you bring down your overall debt position in the future as you work towards retirement and passive income needs in the future. I think it's important to note that debt recycling isn't for everyone at any point. It is a complex strategy, and one that I personally really enjoy implementing for clients, and it's been extremely effective, and it's probably been a growing one. It's a little bit topical at times, and you probably hear people talk about it in sometimes with a lack of maybe knowledge about the risks associated. And I think probably tying through to Delta's last point will be a little bit around that as well. But broadly, sometimes taking on more debt can actually help you get out of debt quicker, which just does feel backwards. I know that does feel backwards, but you've done it in the right way with systems and processes around that. Now, I'll only touch on this briefly, but that may be through property, it may be through shares, managed funds, or other options as well. So for us, it's about keeping our options open once we identify that debt recycling is an appropriate strategy for an individual or household, and then looking to implement that and review it quite frequently to make sure it remains appropriate. And ultimately, we're minimizing our tax. That really speeds up that process. And we're going to make sure we continue to hone that in and continue to work with the brokers, such as the guys at Loan Market, to make sure the rates are tight and the structures are appropriate. So hopefully, again, it's a very, very quick insights into debt recycling, but I think we've got some further content on podcasts and things that we can provide afterwards as well.
Thanks, Ben. A question without notice. What sort of time frame should we be looking at if we were considering debt recycling?
It's definitely a long-term strategy. I think that's a really good point. I think most things that are good take time and effort and some serious planning around it. So debt recycling is not something about flipping debt from bad to good in a year or two. It's a long-term play and something that needs to be done. You need to do it early in your financial journey as soon as it becomes applicable. So you give it time to mature and work at its best. It's certainly something that you don't do hoping for a quick turnaround on.
Mm. And Ben, just further to a couple of points you made there around, sort of minimising your tax position. I suppose when we look at any strategies, we always look to ensure that we're proactive in managing, any tax that we can do so. And that goes right back to asset ownership and ensuring that investment assets are purchased in the right entity or person's name and so on, with a consideration of what happens at a point in time when we might choose to sell that particular asset. So
yeah, again, I think with structures, it's a really interesting area. One we need to be, again, that's where we link in the accountant as well, and we make sure all parties, so you've probably got at least 3 different professionals working as a collective to make sure that one is aligned on all fronts.
Yeah, and I think, as you've already touched on as well, something like that debt recycling strategy that we want to be studying, early with a long-term view, as you touched on, talking to your broker and the loan market team is where we can collaborate and ensure that that's an appropriate strategy for you and that fits around your own set of circumstances. So we have managed to get through fairly quickly. The last dot point around wealth protection. So it's super important that if we're building and planning to grow our wealth and all of that is transpiring, that we do have a contingency plan if things go wrong. So ensuring that we've got an appropriate safety net in place. And that for us is part of the advice that we provide to our clients. And this extends to those whom are self-employed, and they might need to consider things like buy-sell arrangements and so on, and also around the timing of the sale of assets. So considering when we purchase the assets, the appropriate ownership, and then when we might need to look at sale of those assets, again, timing those to ensure that as much as possible we're not selling at a point in time if there's volatility in the market, whether that be property, shares and so on. So having those things in mind and making informed decisions.
It's probably just quickly on that's your topic, that's a bit of a non-negotiable on our end, that protection piece. Like we the last thing we want is people building wealth and accumulating assets to see it unravel on them. So it's very much a big part of what we do.
Yeah, absolutely. We have managed to fly through that content. So I had said we've got 10 minutes for a question and answer session, but we've actually got a little bit longer. So happy for anyone that's present, if they've got a question, to please raise their hand, or if any have come through the chat function at all, Amy. Okay.
Oh, not yet.
Okay. No silly questions. So if something has popped up that you want to ask, feel free to raise your hand, or let me know if you've got a question.
I had a question, Delta. It's probably more of a, so it might be for Ben or even to Sarah around, well, I think it's more of a comment maybe around loans and lending, particularly when it comes to the structure of loans. One of the things that I think is misunderstood by a lot of people when they look at their lending is they're only looking at the rate that they might be able to get from switching from one bank to another. When it comes to things like debt recycling, the structure of someone's debt is critical, and the how that debt is structured and what assets that debt is structured against is also very, very important. So I suppose the point, Ben, I don't know whether you want to add to that as well, just how important beyond the rate and the amount that you can borrow, the actual structure of the debt that you have, particularly when you've got multiple assets that you might be using as security, it's pretty important. And having someone that actually knows how to structure debt in the right way to get all the outcomes that you spoke about, Delta, the right tax effectiveness of it, ultimately is pretty important. So you shouldn't skimp on good advice when it comes to structuring your debt.
I think with that, and with a lot of the products around, and that's where, again, Sarah and the team to jump in on that is there's so many products that actually are tailored to suit debt recycling with movable loan limits and all of these new features that have become topical. So, without that good backing and good advice on the loan structure and the functions that it can provide you, you can also end up running up a lot of costs refinancing all the time on that, where some of those features of those products that they've got available to you, again, anytime we can strip costs back out of that, it's more effective for the strategy and the long-term benefit of that outcome. So again, you need good advice all the way through there. And I've seen so many people sort of try this themselves, and they've sort of got half of it right, but the other half wrong, and it's pretty much been self-defeating. So you need to make sure you've got plenty of advice around those structures and strategies.
I am just attempting to unmute you at the moment, Sarah, as I feel that you've got something to add there. There you go.
All good. So very similar to what's been said before. For us, it's really important to have the understanding of what the purpose of the property is, what their plan is, because often people just think, yes, it's the right thing to do, I'll get an investment property, that's the next step. But it's a lot more than that. So for us, we definitely go a bit more in depth with that. And then obviously the structure, whether it be through the accountant or the financial planner, is we say, this is what we're looking to do. Can you go confirm that matches the plan? And often, it will, but it's just about, we don't give advice on that, but we do have an idea of what that structure looks like. And you're right, rate's not necessarily always the right thing. We want to make sure that it's done right from the start, so it's easier from a tax perspective when you're going through the account, that you're not having to chase backwards, because it's easier to get it right from the start.
Yeah. So key takeaway there is that the loan structure is super important to ensuring that the ease of the utilisation of those proceeds, and then eventually when we look at exiting those specific investments that we might have in place.
Yeah.
Do you want me to answer? Sorry.
Oh, that's right. Just lastly, I was just thinking as well, also, little things about not cross-collateralizing and planning for that. If it's just more than one property, is it going to be two? Or what's your plans with that property? Do you want to be able to release that or use equity in that for shares or other things? So it's important for us to be able to separate those needs as well, and know, it's going to be easy to do the next step.
Oh, that cross-collateralization comment. I had a phone call today from a client who they had really poor advice because they dealt directly with a bank and they had themselves tied in knots trying to untie that. And again, at the time, they wanted funds to finance a property, and that was the easiest option. But now it's creating all sorts of headaches down the track for them. There was a question there. Did you want me to answer that one, or did you want to do that one? I'm happy to.
Sorry, Ben. Sorry, just before you do, I might ask Sarah, just for the record, to provide some more commentary around what cross-collateral, I can't even say the word.
It's a terrible term.
Collateralization actually means for anyone that is not across it.
Yeah, so essentially it's using one security to secure the other. And they're actually joining the properties together rather than, and as the bank sees it, one is required for the other. Whereas if we are doing it's separate, we tend to do a separate portion cash out, and then that money is usually, depending on whether it's against the owner occupier or it's against the investment, we look to structure that to the best way from a tax perspective, and then that's then separate, and everyone knows what that purpose of that loan's for, and then when you go to sell, you're not having to do a valuation on the existing property to confirm that there's enough left over to actually sell it. And yes, it can become a bit of a nightmare. So it's very rare that we have to do that, and we definitely avoid it wherever we can.
Yeah, so you put all the right things in place in the first instance to make it easy longer term. Yeah, wonderful. Thanks, Sarah. Ben, I don't have visibility of that chat question, so I'm happy.
Okay, that's right. It's Michael just asked, what recommendations would you suggest for someone looking to set up an SMSF for wealth generation? So really good question, and probably one we get a lot of. So I think the biggest thing with an SMSF is really just going back to the why initially and working out why that is. So again, that's probably a combination of, from a financial planning perspective and an accountant. So working out, why. A lot of people historically have set them up when they probably weren't what they actually were trying to achieve. So they wanted more flexibility, visibility, transparency around their investments, maybe some control on their own end. there's lots of products around that you can do that with without the costs and overheads of a self-managed super fund, and also the burden of the accounting work and also dealing with ASIC on different levels. So again, probably goes back to the why a fair bit. We certainly have lots of clients with them where it's appropriate. If you're looking at going down the property path, it's inside of super. It's obviously the only way you can do that with direct ownership. And actually only speaking to Sarah, I think yesterday, we were talking about how that marketplace has opened up a lot more, and there are a lot more lenders who are coming back to the SMSF lending market. So I think it's probably going to be a growth area again as we look forward in the next decade. It had really tightened up and closed off. But probably with anything that we look at, no matter what that idea is, we really want to break down the why of that and make sure we're not overcommitting to costs and complexities that could be met with a simpler option. Maybe even just for the interim. We have a lot of clients who the goal is SMSF when scale and other things are aligned, but we've got a few years to go to build to that point where it's ready to tick over and be the best option for them. So I suppose, again, we're probably biased, but get advice, talk to a financial planner, talk to an accountant, probably talk to both. That's probably the key thing there. And then also be thinking of the property side, make sure you talk to your broker. You don't want to set up a fund thinking you can borrow to buy property and find out you can't, because the LVRs and so the borrowing capacities and things inside of an SMSF are much different to just everyday purchase of property for living or investment in your own name. So hopefully that's been helpful.
Yeah, just to add to what you've said there, Ben, so that the serviceability aspect of the loan within the self-managed super fund, if the property purchase is to exist there, is really important. And potentially the other sort of niche area when we look at a self-managed super fund and having a property might be for those that are self-employed and operate their own businesses, where they might like to purchase a commercial premises and be in a position to actually lease that from themselves. So there's sort of additional advantages in doing so. If you've got any other specific questions, happy to run through those now and or discuss them with you in more detail if they're sort of more sensitive in nature. Have we had any other questions?
None in the chat, but I had one, and I'm not sure if it's more for Sarah or Delta or Ben. It was just around LMI and when it might be appropriate for someone to have to pay LMI versus it not being worth them going forward with applying for a loan.
Great question, Amy. I'll let you cover off on that one, Sarah.
Yeah. So, look, there's a lot of opportunity at the moment with LMI waivers, whether it be your employment. So there's lots of that's growing more and more where your employment's able to get an LMI waiver. So that's one thing we look at. We've got first homeowners at the moment, which has got the first homeowner scheme. So that means you can borrow at 95% with the LMI waiver. LMI, for anyone listening, is lender's mortgage insurance. So it's insurance you pay to the bank for the risk of borrowing above 80% of the value of the house. So it can be costly, but it really depends on the individual. So the lender's mortgage insurance is topped on top of the loan. So you are paying it over the life of the loan. So yes, it can be expensive because you're adding it on to the interest. However, sometimes the time that it saves you to build the deposit, to get enough to avoid it, the house prices have gone up in that time and you actually end up just paying more for the property anyway. So it is an individual thing. It depends on your timeline. It depends on what you're doing and what your strategy is for buying the property. But generally, our first instance is to look and say, okay, well, can we find a way to either reduce the LMI, which a massive benefit of going through a broker is we've got 60 plus lenders on our panel. We have choice. We can look for we've got to find the happy medium. Is the rate good? Is that lender's mortgage insurance more? What's the loans most suitable? So it is more of an in-depth conversation, and it really depends on your plan. But there are lenders at the moment who are doing 85% with no LMI. So that's getting closer to the mark. So yeah, there's lots of opportunity. Again, it will depend on your personal circumstance, but in some cases it can be worth paying for.
Okay, good to know. Thank you.
There just something you touched on there, employment fields that might enable an LMI waiver. Could you just run through what some of those might be out of interest?
Yeah. So medical, medical nurses, certain doctors, you've got veterinarians, physiotherapists, accountants, legal, or pretty much a lot of the legal fields are covered, and each lender will have a different kind of specification, and they are getting broader. So they're adding more and more, but they're kind of your major ones. Even radiologists, there's a big range of them, but essentially it's worth chatting about. Engineers is another one. So yeah, it's fairly broad. So if you think that you're looking at it and you want to chat about it, just get in touch and we can run through the options.
Sarah, is that fair to summarise that those employment fields would have tertiary qualifications? Is that
correct?
Sort of
yeah, correct.
Yeah.
Yeah, that would have probably been a better summary.
No, I was just trying to, in my own mind, assess what the bar or the hurdle was in that respect.
Yeah,
so
it started off as like a professional. That's like you started off as professional, as a professional LMI waiver. That's kind of where it started, and yeah, it's sort of branched out to more opportunities. But it's if you can do that, 90% is where it sits. 90% LMI waiver, so that's kind of the max that they go to, and it can be in some instances investment properties as well. The other thing quickly, there's not as much of them because there is a scheme, but you can look at doing a parental guarantee or family guarantee, which also waives the need for lender's mortgage insurance. So it's a little bit more complex, a little bit more involved. However, if you're in a situation where you're not a first homeowner or you're not qualifying for one of the schemes, then we can definitely look at that as one of the options. So as long as the serviceability there, that again is another help to get you into the market sooner.
Okay. So the key takeaway from that point, Sarah, is speak to a broker.
Correct. Yeah, we've got lots of options. So talk to
Thank you, Sarah. Have there been any other questions from the audience? We've got about 2 minutes left, so happy to take anything else that might have popped up along the way. No, doesn't look like there are any other questions. So I suppose a couple of questions from me that I'll touch on. If you've got questions from tonight's presentation and you think I'm not sure where to go from here, we've piqued your interest in respect to some options that you might have in front of you. You can feel free to reach out to either of the teams, so the Burke Britton team or the loan market team. We work together and collaborate to ensure that our clients have the best possible outcome. So ensuring that we're all on the same path with the same plan in mind to enable our clients to achieve their goals. And the final question, I suppose, where can you find more information? So our website has a wealth of information on there, some short videos, and we do have our own podcast series called Fine Answers. And it's got a broad ranging topics, so you can feel free to jump on and have a listen to any of those. Again, if anything in tonight's presentation is relevant for your own situation, friends, family, feel free to reach out to either the Burke Britton or loan market team. You can jump on our website and book a meeting or initial sort of discussion if you would like to do so. And just a plug, remember to follow us on our social media channels. Loan Market Geelong team and Burke Britton team are active on there. So again, thanks very much for joining us this evening. We're just on 30 minutes. So I appreciate everyone at this time of the evening getting together.
Thanks, everybody. Thanks, Delta.
Thanks, Ben. Thanks, Sarah.
We hope you enjoyed today's episode. If you're keen to understand more about how financial advice could benefit you, follow us on Instagram, Facebook, and Twitter at Burke Britton FP, or Google Burke Britton Financial Partners. Check out our client reviews, testimonials, and make a time to meet one of our certified financial planners by clicking Book Now on our website. Thanks for listening.
Any information contained in this podcast is of a general nature only. No account was taken as to the objectives, financial situation, or needs of any particular person. Therefore, before making any decision, listeners should consider the appropriateness of any information with regard to their particular objective, financial situation, needs, and seek independent advice from a licensed professional specific to their circumstances.
All right, hit it.
That translates to don't be a moron and act on what some random person says on a podcast. Take personal responsibility, do your homework, ask questions, and speak to an actual human that knows what they're talking about before you do anything. PP Financial Solutions Proprietary Limited, trading as Burke Britton Financial Partners, are authorised representatives of AMP Financial Planning Limited, AFS, licence number 232706.